Good morning. Thanks for taking the time to join us today for our webinar on moving to the U.S. 101. My name is Krista Rabidoux, typically of the Alberta office, but currently sitting here in Vancouver.
And welcome to Vancouver, Krista. My name is Steven Flynn. I'm a partner with Andersen, and I'm in the Vancouver office normally.
Today, we're going to be focusing on 8 different categories here on what you can think about when you're potentially looking at moving into the United States. Our primary focus is going to be moving from Canada to the US. However, a lot of the areas that we're going to be covering may allow from other countries going down into the US and things you might contemplate.
We're going to keep this to an hour today. We appreciate you joining us. We're going to have time for questions as well. So on your screen, you'll see a question and answer box. Please ask away, and we'll leave some time at the end, and we'll cover as much as we can.
Awesome. So the first area that we're going to be focusing on is tax residency. Sorry, tax residency. And now when you're looking at tax residency, you want to look at both the Canadian and the US side of the border. We did cover this a little bit last time we did a webinar, but it's very important, I think, every time when you're talking about moving across countries to discuss this matter. Canada uses more of a subjective approach, whereas the US uses more of an objective approach. Canada says, if you're here 183 days, we think you're a resident. Pretty simple, pretty straightforward. Whereas the US, you want to look more towards either the 183 days in 1 year, or they have a 3-year test that they look at. It's called the substantial presence test. Now, if a lot of times we see snowbirds who go down to the US, they spend 120 days, they're a U.S. resident under the domestic law. Now, we're lucky in the sense that we have the treaty between Canada and the U.S. And under the treaty, there's 5 different categories in which you look at in order to determine if you are going to be a resident of the United States when you move down there. Now, a lot of times you're going to move, your intent is to move, so you're going to plan ahead of time to ensure that you're going to cut enough ties to Canada in order to have that move made. The first one you look at is whether or not you have a home. Now, if you don't have a home in Canada, you have a home in the US, that's a pretty clean break from Canada to the US in the sense that you don't have anywhere to come to in Canada.
Absolutely. And a home can mean a lot of different things.
That's
home
right.
can be a home that you own. It can be a rental accommodation that you have.
That's
it
right.
Can be a number of different venues. The biggest thing is that it has to be available to you for your use. You leave your personal effects there. You come back and forth as you please from that place.
That's right. And even available for use could be if you leave it open, but you have your family staying there. Sure. And you leave a room for yourself. That is available for you to use at any point in time, even though you have someone else staying there. So it's just having that availability to come when you come and go as you please. Now, if you have a third party tenant in it, you no longer have that availability to come and go as you please. So you somewhat cut that tie. If you happen to have a home in both countries, you're then going to look at where your center of vital interests are. So where your economic ties are and where your personal ties are. So your family and your money. There are lots of situations where one spouse is going to move down because they get a job and the other spouse stays up in Canada. That could potentially create a tie between the 2 countries because you're going to have a home, your family's there, you're going to have a personal tie to Canada. So you really need to make a strong argument whether or not the economic tie. And if you can't kind of break it there, you're then going to go to where your habitual abode is. Where are you spending most of your time, right? Where are you going to put your head on a pillow at the end of every night and be there greater than half the time? And generally we can kind of break the tie at that point in time with an individual. But if you're truly spending 183 days there and 182 days here, you're not as necessarily going to break your tie, where then you have to go to citizenship. As many people know, there's a lot of dual citizens between Canada and the US because our borders are so close. People come and go across the different borders. And if that doesn't break the tie, then you're going to be looking at competent authority, where you don't really ever want to get to. You don't want the IRS and the CRA deciding that for you. You want to make the decision. So it's creating those the bright line test, as we call it. You want to plan enough ahead in advance so that you're creating enough of a break from Canada if your intention is to move to the US and not leaving kind of any ambiguity between the two situations.
Well, that's right. And as you can hear, there's some flexibility, and a lot of people have control over where they're going to be as they're making this move from Canada to the US. And that creates some opportunities, whether that's to avoid potentially Canadian taxation on a big bonus payment when you're going to the
That's
US.
right.
We can control when you're leaving, when you're leaving Canada. Alternatively, we may want to have some events that are taxable in Canada that we don't want taxed in the US. We want to delay the change of residency. So the treaty gives us that flexibility. And you'll hear this theme again and again this morning, that the more you can plan in advance for this kind of move to the United States, the better your opportunities are, and the more we can employ certain strategies to help you and your family.
Exactly.
One of the things that happens when you leave Canada is, as a Canadian resident, you're subject to tax on your worldwide income and your worldwide assets. Once you leave Canada, Canada can no longer tax you on your worldwide income. Even though you may be a Canadian citizen, Canada tax is based on residency. So one of the provisions under Canadian tax law is that when you leave, you're subject to what's called an exit tax. It's a deemed disposition of certain assets that you own for their fair market value on the day that you leave the country. It's Canada's last chance to tax you on your worldwide income. And where this catches people is when they have appreciated assets, when they've got unrealized gains in certain assets, things such as they may own real estate outside of Canada. That would be subject to a deemed disposition. They may have a securities, they may have a registered, non-registered investment account. There's been a big appreciation when people are trading in public securities over the last year. Those unrealized gains now become realized. Mm-hmm. So there's this tax that occurs. There are exceptions to these rules. For example, if you own Canadian real estate, your principal residence, or you've got rental property in Canada, if you own that directly, that would be exempt from taxation. It'll be taxed eventually when you do sell the property, and Krista will talk more about that later. Mm-hmm. If you have an RRSP, a registered pension plan, other types of pension plans or deferred accounts, registered education savings plans, even tax-free savings accounts, those are exempt from the Canadian departure tax rules. The other asset that is subject to departure tax is interest in private Canadian companies. So you have a business, you have an investment company. If you've got shares in a Canadian company, that will be subject to departure tax. And so, this sounds like a bad thing. This sounds like something that's perhaps a deal breaker when you're moving to the US. There are solutions. And one of the solutions is to simply post security, to go to Canada Revenue and say, yes, there's a tax, there is a gain here, we're going to have to owe something. But if I can secure that tax, if I can go to Canada Revenue and provide security, whether that's in the form of a letter of credit with a Canadian financial institution, that's a choice you can make. Typically, you'll have to set aside or segregate some assets to put into that letter of credit. There'd be a fee for that, usually a 1 or 2% charge on the amount each year. So that's one way to do it. Another way to do it would be if you own Canadian real property, and if you can put a security charge against it, that's another way to provide security. A third way is if you've got shares in a private Canadian company and you control that company, you can pledge those shares themselves to Canada Revenue. They'll accept that as security to say, we won't collect the tax now as long as you securitize what we can collect later. That's fine. Pledging the shares as security has some restrictions on it. In general terms, you're supposed to ask permission from Canada Revenue to reorganize your affairs within the company, whether it's a share reorganization, to pay dividends from the corporation. Canada Revenue's always trying to make sure that they've got at least 2 times coverage on the tax liability. So, for example, if the tax liability that you wanted to defer was $100,000, they would want to make sure the value of those private security shares were at least $200,000 or more. So that's one way to approach it. There's a de minimis rule as well, that if the tax overall is less than $25,000, it depends on the province, you can post automatic security. It's filling in a form and committing to Canada Revenue. And if it's a de minimis amount, they actually don't need any security at all. So that's one way to approach it. Mm-hmm. What the advantage there is that it's really an interest-free loan. because you don't have to pay that tax until you actually sell the securities or sell the asset.
Right. And you're deferring the tax.
You're deferring the tax. So we often counsel people to say, well, if you don't need to sell those assets,
That's right.
hang on to them for decades. You won't owe that tax for decades. And so it's a process you go through.
Yeah.
As you go through this calculation of the departure tax, you can take into account certain attributes you may already have. For example, if you've got capital losses, you can use those against the capital gains. There's other things, Krista.
There's the qualified small business shares.
Sure, tell us more about that.
If you want to sell, you have a deemed disposition, you may choose not to defer it, because if you're moving to the United States, qualified small business shares or qualified farm property, Canada has the certain amount that's excluded, whereas the US doesn't have that. So you might not want to defer deeming that disposition, because you can not be taxed on that in Canada, receive a bump up in basis in the US, and you're kind of winning on that situation, right?
So you may want to choose to actually trigger the gain, use your lifetime exemption, and go forward on that basis.
Yeah, and it's, I mean, the other thing is 5 years. If you've only been in Canada for less than 5 years, the departure tax rules are slightly different, because if you owned assets prior to coming to Canada, you were here, say, 58 months, I think you had a situation in that. It was very close in that situation. You may choose to leave, because anything you owned prior is not going to be taxed in Canada under the departure tax.
Right. So for short-term residents who've come to Canada and then left, there's that opportunity. For long-term residents that have been here longer than 5 years, you wouldn't have that opportunity.
Exactly.
So what happens from a Canadian tax perspective is if you are subject to this deemed departure, this tax, this deemed disposition, your cost basis for Canadian tax purposes now becomes the fair market value of whatever that asset is when you leave. What you want to try and do from a U.S. tax perspective is have the same treatment. The idea is that when you do go to sell it down the road, you want the gains to be similar, so that if you're going to pay tax in one country, you can get a foreign tax credit in the other country for the same amount of gain, making sure you're not paying tax twice. So one of the options we have here is something called an election under the Canada-U.S. Income Tax Treaty. And it can basically point to those assets and say, for U.S. tax purposes, I want the same thing to happen for U.S. federal tax purposes that already happened for Canadian purposes. And so when I come to the United States, my cost basis is now not the original cost basis, which it would be if you did nothing, but it's the fair market value of that asset. So if it's gone up in value, you've got a higher cost basis. Down the road, when you sell it, you'll pay less U.S. federal income tax on that.
Mm-hmm. You often hear people saying your move is going to be probably the most complex tax year you will have endured, because there's so many things that if you don't do it, the elections and so forth, it can cause you a lot of tax dollars.
Absolutely. So, no question. You want to be able to analyze these assets and make these decisions. The last thing you want to do, if you've moved, let's say in 2021 and you don't deal with it, and you come to April 2022 and say, well, now I got to file a tax return. You've taken away some advantages of trying to, well, do I do post-security? Because that takes some time, or do I make some choices on certain assets? You want to be able to do this in advance.
Exactly.
The other nice thing about deferring the tax by posting security is that if you decide to come back to Canada, you can undo everything that happened. So when you move back to Canada, you can effectively unwind this deemed departure. You can basically reset everything to where it was when you first left Canada. And the nice thing about that is you can effectively reverse all of the taxation. If you had an appreciation of these assets during the time that you were outside of Canada, that appreciation eventually won't be subject to Canadian income tax, because Canada has a rule that states that when you come back to Canada, your new basis, your new cost basis on those assets is the fair market value when you enter Canada. Mm-hmm. So we often see this kind of planning opportunity. I'm going to call it a bit of a home run opportunity, where someone goes to the United States, they're not a U.S. citizen, they're not a green card holder. They have a significant amount of unrealized capital gains. They maybe have an event with their company. They leave the United States. In the United States, if you're not a U.S. citizen, or if you're not a U.S. green card holder, there is no exit tax when you leave the United States. They can come back to Canada, have a much higher cost basis, effectively avoid U.S. and Canadian tax on that gain. So a real huge win on that.
That is, and you'll hear it in our theme throughout today, planning, thinking ahead and getting the right dots in the right place before making a move is super important.
Absolutely. Departure tax sounds awful. It sounds complicated. It sounds like a real deal breaker when you move to the U.S. It isn't.
No.
It's something that has to be managed. It's something that's got to be dealt with. It sounds a lot worse than it really is. That's
right. Exactly. And a lot of the time when people are leaving, they're asking, can I keep my house?
Absolutely,
right?
Yeah.
Like, can I keep my home in Canada? And the simple answer is, of course. I mean, there's no deemed disposition on real property, as Steve alluded to earlier. You can keep it in Canada for as long as you want. The choice is, what do you want to do with that property when you're keeping it in Canada? And why are you keeping it? Some people want to keep it because they want to, it's an investment and allow the appreciation to happen. Some people keep it because they want to have a vacation property to come up to Canada to visit family, or they want to rent it. So there's many options that people can choose when they're leaving a property in Canada. But the simple answer is yes. You can keep it. Now, if you choose to keep it for personal use, you risk that, as I talked about earlier, that residency, the treaty tiebreaker. So you're not going to have a home available to you in both countries. So if you're doing that, you're really going to have to focus on the economic and personal ties and making sure that you're breaking under the second level of the treaty, because you don't want to have a situation where Canada is saying, well, you actually have a home here, so all your income should be taxed here. And so you want to be careful in that situation if you decide to keep a personal home in Canada. Not to say it's not possible. Lots of people have vacation homes in multiple countries.
Absolutely.
But if you're looking to rent it, that's kind of a different situation in which you have to plan ahead again, because you have to think about the different ramifications as a non-resident earning income in Canada. Rental income is one of those things where I'll talk about a little bit later, that you still have to file a tax return and you still have to pay tax in Canada. Canada forever has the right to earn or to receive tax on rental income. There is situations, and this is more applicable to individuals who are thinking of, you're going for a 5-year contract down to the US. Your employer wants you to go work down there. You're planning to be temporary. You're going to keep your home because you want to come on back up to Canada eventually and move back into your house. There's a situation in which you can make an election. To have that rental income, you report the rental income, but in Canada's eyes, that property will forever be your principal residence when you come back, and you don't kind of lose that period of time in which you had rented it out. Now, in that situation, you need to be careful not to claim depreciation, because that you can't claim the election and claim depreciation. So you can only just report the income and expenses such as utilities, mortgage interest, stuff like that. And that's okay. But the win there is you actually get to come back, move back in. You don't have any change in use dispositions that might occur, and not be taxed on the gain of the principal residence. Now, this can be a good win because you need to plan ahead. You're being temporary, and you're going to be able to not owe tax on anything. Now, if you choose to sell that property while you're in the U.S., there is a requirement to apply for a clearance certificate in order to show that disposition. The purchaser will have to withhold anywhere between 25 to 50%, depending on what the property is.
And this is 25 to 50% of the gross
proceeds. Yeah, exactly. So gross proceeds, 25 to 50%. And then when you apply for the clearance certificate, which has to be filed within 10 days of the closing date of the sale, Canada will come back and issue it, generally minimum of 90 days before you hear back on that, and state how much the buyer can release to you of those withholdings for your final tax liability. So it's a timing issue of cash, if you will.
And it is a timing issue, and eventually what Canada Revenue will come back is they'll say, well, we don't want 25% of the gross proceeds. That's far too high to cover the tax liability. We'll let you calculate what the gain is. We'll let you take into account what your cost basis is when you purchase the home, and we'll take 25% of the net. That's probably still a little bit too high. It's a temporary tax, it's a withholding tax. You'll reconcile it all and file your tax return. The timing is what catches people off guard, because it takes Canada Revenue at a minimum 90 days. With COVID and all the delays, we've seen it take up to 5 to 6 months. It isn't a huge process to fulfill this obligation to prepare the form and get it filed. And you're usually done, by the time of closing. But when you think of kind of the normal closing process, you really can't start preparing this application until you have a signed offer. Usually the time between the offer and the closing date is 30 to 45 days. I think in my decades of doing this, I can remember one situation 20 years ago with a special set of facts where we got that approved clearance certificate from Canada.
Without them asking for more information or anything, back and forth. And
every other time it comes after the fact. And as a seller, you just got to be aware that there's a cash flow difference. You're going to have more tax withheld. It's going to stay with your lawyer's escrow account, in a trust account, it won't be interest bearing. You'll get that money eventually. It just takes time post-closing to get
That's right. And it's important to note that on here, the U.S., if you sell that while you're in the United States, they're going to want that reported. The U.S. doesn't have the same principal residence exemptions that we have in Canada, which is an unlimited dollar amount.
Right.
The U.S. is limited to gains of $250 per individual. So if it's a married couple, it's $500,000. So you just need to be cognizant of when you're selling the property and whether or not it's going to trigger it again, because it will be taxed in the United States. And taking into account foreign exchange gains that may have occurred or losses, there's different things, or mortgage. If you have a mortgage on the property, you have to calculate currency exchanges on that too. So there's a lot of things to kind of account for when you're looking at selling the property versus just selling it if you're not a resident of Canada, especially and even in BC.
And on that topic, there are provisions in the Canada-U.S. income tax treaty that if it is your principal residence, you generally wouldn't be subject to U.S. tax if you sell it shortly afterwards.
One
of the provisions under Canadian law is that you can continue to treat the property as your principal residence as you described.
That's right.
But when you're not living in Canada, when you're not a Canadian resident, the formula will kick out those years that you're not living here. And so if you held on to your principal residence for a couple of years after the fact, some portion of that gain might be taxable, even though what we always kind of think of as a principal residence, that it's never taxable in Canada.
Yeah.
So when you look at the formula,
and Canada has a +1.
It's a +1 rule. There's some complicated math that goes on, but the general gist is this: is if you can sell your principal residence within the year after you move, by the end of that following year, you shouldn't have any Canadian tax if it's always been your principal residence.
That's right. Yeah, exactly. Yeah.
Krista mentioned something in particular about British Columbia. And in British Columbia for about 3 or 4 years now, we've had a unique set of taxes that's unique to North America that are speculation vacancy or empty homes taxes. The idea here is that if people own properties and they're not used as either their principal residence or not used to earn rental income, that there's not a primary tenant in there, or certain other exceptions, that both the city of Vancouver and the province of British Columbia will assess a tax based on the assessed value. And so for a non-resident of Canada who owns property in these regions, and in British Columbia, it's the Greater Vancouver Regional District, it's the Fraser Valley, it's Nanaimo, it's Victoria, it's parts of the Okanagan. If you own a home in these areas and you're not a resident of Canada, that provincial speculation vacancy tax is 2% of the value of the home. So the $4 million condo in Vancouver that you may be living in the United States and you're using it as a vacation property, you're paying a tax every year of $80,000. So what people will do to avoid that tax, they'll rent it out. And as long as it's rented out to someone who's using it as their own primary residence, that's fine. The caution you have to watch with the provincial levy is something called non-arm's length rentals. So that even though you might have a family member or a close friend that maybe is paying a really discounted rate, you see it oftentimes, you say, well, just stay in the place and pay the utilities, I'm coming back in a couple of years. That won't satisfy the rental test.
Yeah.
And so there's a complex formula you have to go through that tenant has to actually have taxable income in BC more than 3 times the value of the fair market value of the rent, not what you're charging, but the actual fair market value of the rent, which can often be a hard test to meet.
That's right, yeah.
There are solutions for that, and they evolve anywhere from having taxable income in Canada, making sure the foreign taxes work. There's credits there. Having someone occupy the property and fulfilling that formula. There are ways to work around it, but it is something that's a very unique tax that's that one has to be mindful. Of course, often when Canadians move to the United States, they've got interest in RRSPs, in registered pension plans. And in general terms in Canada, those are tax deferred until you take money out. The same treatment happens for U.S. federal income tax purposes. So now you become a resident of the United States, you get the same result. You're only taxed from federal tax purposes if you take money out of the RRSP, out of the registered pension plan. So that's a nice advantage because now you're timing the income in the same years and the same characteristic in both countries at the same time. We're not paying tax twice. You don't have to do anything to get that result. That's kind of an automatic concept now. When you take money out of the plan, Canada will still tax you, but the tax rates and the tax regime is a lot different than if you were living here. So if you're a U.S. resident, a non-resident of Canada, and if you take funds out of the RSP, if you do it on what's called a periodic pension basis, if it's on a periodic withdrawal or periodic contribution basis, the idea is that the withholding tax is 15%. And that's a final Canadian tax. You don't need to file a tax return in Canada. You don't need to do anything else. You pay the 15%, you're done. That periodic pension payment definition is fairly limited. It's limited to, in general terms, payments that come out of a registered retirement income fund or a RIF. So you don't need to be 71 to convert it. You can convert it to a RIF at any time, but you have to go through that process of actually taking the RSP, converting it to a RIF, and then when it's a RIF, you've got these annual payments you got to get out. That's what's going to generate the 15%.
You know, it's interesting because a lot of the times when clients contact, they're told that they have to take out their investments out of Canada when they leave, and the issue with that is we're looking then at the 25%, right, versus the 15%, and there is mechanisms in which you actually don't have to take it out when you leave Canada. You can leave it in Canada. There's no tax to leaving it in Canada. Right?
Absolutely, so, and it can be managed. Even though you may be living in the U.S. and your financial advisor is in Canada, they may not have a U.S. security license. That shouldn't matter. Yeah, there is exemptions under the U.S. securities legislation that your Canadian advisor doesn't have to have a U.S. securities license to manage a pension plan, to manage an RRSP or a registered payment plan. So you can leave it there. As Krista said, if you take the money out outside of a registered retirement income fund, it's subject to a 25% flat tax. Again, a final tax, no need to file tax returns in Canada, but it's much higher. It's a much higher levy. When you're in the U.S. as a U.S. resident, if you take the funds out, some portion of that withdrawal may also be subject to U.S. federal tax. The idea here is that from a Canadian perspective, everything is subject to tax because we got this big deduction when we made the contribution. From a U.S. perspective, particularly if you're a non-U.S. citizen, if you're a visa holder, you may or may not have basis in the RSP, and in particular, all of that or most of that withdrawal may be subject to U.S. federal income tax. There's specific provisions in the Internal Revenue Code. They've been there probably 16, 18 years now that are targeted to employer-sponsored funds. So if you've got a registered pension plan that's maybe converted to a locked-in retirement account, maybe you had a group RSP with an employer where they matched your contributions, you're not going to get basis or basis for the contributions you made, and you're not going to get basis for the contributions your employer made. So when you go to withdraw the funds, all of the amount will be subject to U.S. federal income tax. If it was a self-directed RSP and it wasn't connected to your employer, you may get basis in your contributions, just depending on the circumstances. So what we want to try and do, because we're paying this 15%, we're paying this 25% tax, if we can lower the amount of income subject to U.S. federal tax, we can take that excess credit and we can use it against other things. We can use it against other types of non-U.S. income to lower our overall federal tax. So we're trying to look at ways we can increase our cost basis in the registered retirement savings plan, in the registered pension plan.
Yeah, and I mean, not all states follow that, right? So it's kind of, you have to, some states don't tax pensions, some, as in California, decide I'm going to tax everything, right? So,
well, and that's what really catches people by surprise is that they move to the United States and the U.S. federal tax is one regime. It's a set of tax returns, a set of laws. Every state has its own tax law. It doesn't necessarily follow or is consistent with U.S. federal tax. So in Canada, most provinces follow the federal law. Very different in the United States. And as Krista says, California is a very different place. For example, in California, a registered retirement savings plan, a registered pension plan, it's not considered a deferred pension plan for state income tax purposes. It's treated as an investment
That's
account.
right. Yeah.
So while you're deferring gains and dividends and investment income within the plan, if you just don't take any money out for U.S. federal purposes and Canadian purposes, for California state purposes, those amounts are taxable right away.
Yeah.
And so there's a mistiming between the two. And in fact, when you go to take money out later, and if you're living in California, the act of making a distribution actually isn't taxable in California. It's just like taking money out of your own pocket. Yeah. So there's a real mistiming there. So one of the strategies we often see is for individuals, before they leave Canada, before they go to the United States, within their RSP, within their registered pension plan, that they sell the assets they have and repurchase the same ones. Mm-hmm. There's no Canadian tax implications to do that because it's in a deferred plan. But what it may be able to do is increase the cost basis, increase the basis for state tax purposes, increase the basis for certain types of RSPs for U.S. federal purpose, lower the amount of tax that's going to be, lower the amount of income that's going to be taxed on these plans, and for federal tax purposes, may allow us now to claim more of that foreign tax. We paid that 15 or 25% against other income. Exactly. And for state tax purposes, we can not have as much gains tax down the road.
Again, planning ahead, thinking ahead towards the move.
Yeah, absolutely.
Oh, sorry.
Go ahead.
One of the things that we need to think about when you cross that border on the U.S. side is how are you going to file your U.S. return? There are some options depending on how much time you're in the U.S. So if you move to the USA in September, there is the possibility you may be able to file as a non-resident, depending on how you create those ties. The benefits of that is you only have to report your U.S. income. If you have something, as you mentioned, a sale of something that's going to happen it's going to happen in October, but you need to go in September, that wouldn't be taxable in Canada and you don't want it taxed in the U.S. There's different reasons in which you may choose to stay as a non-resident for the year and then gain residency in January 1st. But you have to fall within the certain stipulations. You can't have been in the U.S. for a certain period of time. If you are in the U.S. and you are having that, as we discussed earlier, the bright line test where you moved, you've cut your ties to Canada, you're down in the U.S., you then have two options of the dual status return or a full year resident to alien return. And now this really comes into account in what did you earn prior to your move? Does it make sense, depending on your family situation, to file as a full year resident and create the married filing joint status? Because as a dual status resident, you can't file married filing joint. It would have to be separately. There might be different deductions you can claim, get access to if you determine to file as a full year resident. Now, the benefits of that is if, say, you move to the U.S. in, let's say, February, for instance, and so you only had a month in Canada, and you had minimal income, you had minimal dispositions that you needed to report, and you were married with children. Filing that married filing joint and making that election as a full year resident could be beneficial because you're now doubling your standard deduction from $12,000 to $24,000 or whatever it is. You're getting to the ability to claim dependents potentially if they have social security numbers, and you're going to reduce your tax or also increase your foreign tax credit if there's, say, you had something in Canada where the income tax was more in Canada than the US. You're going to create this pool of foreign tax credits. And one of the things you'll always hear a cross-border professional saying is minimize tax, increase foreign tax credits. Now that seems counterintuitive, if you will, minimizing tax and increasing foreign tax credits, but Canada inherently on a majority of assets has a higher tax rate. Not all assets, but a majority of assets, there is a higher tax rate. And foreign tax credits in the land of a tax person is like a bank account for deductions or credits in the future. You want to store those. They're available for carry forward in the United States for 10 years. So that potentially, if you have a transaction that might happen in the future where your Canadian tax is less, at least you have that pool available to you to offset the tax in the future. So there are different benefits to making that choice of filing a full year U.S. return and not always just automatically carte blanche doing the dual status return without looking at those alternatives, right?
Absolutely. And we were talking about that example I had yesterday. I did a little homework this morning. So about 4 years ago, we had a client in this situation, and they and their family were moving to the United States. They were coming from Canada. We went through the analysis, and the simple, straightforward answer was you can be a dual status alien, you get a clean break from Canada, pay your tax here, go to the U.S., start paying tax in the U.S. And we went to them and said, however, here's your choice. Because you had certain income in Canada before, and because your status of instead of being dual status, filing separate returns, if you want to file a full year U.S. federal return, state return, file as a joint. The advantage is some lower taxes in the U.S., but you're going to include all this other income you had before. Mm-hmm. You'll actually pay in the year you move overall $8,000 more. Well, that sounds like a bad idea.
That's right.
But we said, but here's the thing: is that we know you travel a lot for work. We know that you're going to have some foreign or some non-U.S. work days going forward. We think if you can do this over the next 10 years, you're going to have this $25,000 foreign tax credit pool. Mm-hmm. So you're paying $8 now. You're going to get 25 later. So it's a triple, it's a 300% return, whatever you want to call it. I went and looked at it this morning. Now, in the first 3 years since they've been gone, they've used about $17,000. So we're not in bad shape. I haven't seen their information for the 2020 year. My guess is they didn't leave the U.S. at all.
Not many people were moving around. Not many people
traveled. So I don't think we're going to use it any for 2020, but they still have, another 6 years to use these extra $8,000 of credit. So it was a really good win for them.
Exactly.
And those are the kinds of things you want to try and do before you actually step and file a tax return, to analyze what are my choices. It's
always in the tax world, we say what you don't know, you don't know, right? So it's important to kind of look at that full landscape and getting to understand what is your plan, what is your future, not only planning in the year ahead of time, but also what's your plan for the next 10 years? Yeah. Is this going to provide you with any benefit?
Absolutely. Yeah. Well, one of the most exciting ideas that we have, and it's one that's often overlooked, is the idea of not focusing on income taxes so much, but payroll taxes. So payroll taxes. So Canada pension plan premiums, fairly inexpensive compared to the United States. So for someone making about $65,000 a year, they, as an employee, pay about $3,000 Canadian. That's their maximum. So if they make more than about $65,000 a year, they don't pay any more because they're capped at $3,000 is about the premium. The employer pays the same. In contrast, in the United States, the rate for U.S. Social Security and Medicare is much higher, and it calculates much longer. So for the first $143,000 U.S. of income, the employee's rate is 7.65%. It's two components, 6.2% of Social Security. It's 1.45% of Medicare. Once they go past that amount, then their tax for Social Security stops. But the Medicare, the 1.45%, continues. And it continues. If you make $1 million a year, it's still being applied. And so, your tax rates in the U.S. are far higher for payroll taxes. But there can be exceptions. And it's the exceptions is where there's some real value here. If you're transferred to the U.S. on a temporary basis, and that temporary basis is generally defined as 5 years or less.
Yeah. I mean, there's extensions available, but it's 5 years. Yeah.
But if you're transferred to the U.S. on 5 years or less, and I would say that most transfers we see or most moves we see, you can define them as a temporary transfer.
That's right.
If you do that, you can elect and choose to continue to be covered by Canada Pension Plan for the first at least a minimum 5 years, and you can exempt yourself from the U.S. Social Security and Medicare taxes. And so you can do that for employees. You can also do that for self-employed individuals in certain circumstances. We're working through a number of situations right now where an individual is an employee of their own company. They own 100% of shares in Canada. They're going to go to the United States, do a similar business. They can form a U.S. corporation themselves, be an employee of that corporation. That's going to qualify as a transfer between two companies to allow them to continue to be covered in Canada and exempt themselves from U.S. Social Security. So what are the dollars here? Well, take someone making $150,000 US a year. If they remained on Canada Pension Plan, their premiums are $2,500 US, $3,000 Canadian, let's say. If they didn't do anything, if they stayed in the US, their premiums would be about $11,000 a year US. So what's that difference? Would you rather pay $11,000 or would you rather pay $2,500? Well, if you consider this a tax as opposed to an investment in your future, that's about an $8,500 savings a year. If you do that for 5 years, you're looking at a $42,000 savings.
Yeah, that's huge.
Absolutely.
That's huge.
And that's the employee side.
Yeah.
If you're self-employed, you're paying both ends of this. Just double it. That's about an $84,000 savings over 5 years. Yes, there's some work to do here. You got to form a U.S. corporation. You've got to make an application. It's worth the effort.
It is worth the effort
to get qualified here. And I often tell people that, again, great if you can plan this in advance. Mm-hmm. If you've been down in the U.S. a couple of years and you haven't considered this idea, we've had some successful retroactive applications where we actually go back, get qualified from the start of the transfer, amend the U.S. payroll forms, recover that payroll tax, and get that benefit. So it may not be too late. It's one that we see that we can execute a little bit easier with smaller companies. When people are with the Apples, the Googles, the Microsofts, it's a little bit harder to execute because they're a bit rigid and a bit strict on how they do things. Right. So that kind of non-routine transaction would be very difficult for them. But there's an incentive for your employer to do this because it's going to save them the same amount it saves you. So definitely worth its while.
Absolutely.
Yeah.
Absolutely. And so earlier I kind of alluded to the rental income being continued to be taxed in the U.S. Not moving forward. Graph, if you can.
Yep.
Canada still has the right to continue to tax some asset or some income amounts. Sorry. So I talked earlier about the rental income, so I'm not going to really talk too much about that. But services performed in Canada may still be taxed in Canada. This past year, we saw a lot of people deciding to kind of lay foot in a country, continue to work, even though it's not necessarily their resident country. That has caused some, I guess, ambiguity in who gets to tax all of this employment income, right? Canada has been a little bit more forthcoming with some general guidelines as to what they're going to interpret as being employed in Canada, and who's going to be determined a resident of Canada for COVID purposes. So they've taken the treaty just kind of that one step further, saying, okay, we'll interpret, if you were a Canadian and you followed our guidelines and said, okay, I'm going to come back to Canada following travel, that's going to be a travel restriction, and we're going to kind of ignore it for purposes of employment income. But typically in a normal, non-pandemic planet, if you come to Canada as a non-resident and you still continue to work, that employment is potentially taxable in Canada as well. Absolutely. So you really need to be careful in that where your services are performed. If you come up for meetings, they're going to kind of not look at that. That's not really performing services in Canada. But if you're coming up and actually performing services for contracts, for clients, for business, it could fall in the category of being taxed. The other areas that are taxed are areas such as dividends and royalties. Now, these don't require an actual tax return, whereas real property activity and services performed would require a tax return to be filed. But dividends and royalties and pensions and those types of items, Canada's going to withhold the tax, and then that's your final tax liability. There are situations where people forget to tell their financial institutions that they've left. In that situation, you have to voluntarily write a letter to CRA. Sorry, here's my tax.
It's a bit more of it's an awkward process. Yeah. It involves a little more work, more professional fees. If you can do it at the start, saying to your financial institution, I now live here.
Yeah, they'll take care of it.
Then they'll calculate the appropriate rate based on where your country residence is now, and it'll make a lot more sense.
Exactly. Yeah, and so interest under the Canada-US Treaty is not taxed, so you can continue to earn tax in Canada, no reporting, no tax. It will be taxed in the United States, of course, but in Canada, there's nothing to report. And then also under the agreement between Canada and the US, CPP and OAS is tax-free in Canada. Again, taxed in the US, you will report it on your US return and pay the tax on the amounts there. But in Canada, they have no right to receive it at income tax on.
Right, and that's an agreement that two countries reached probably 2 decades ago, where it's a quid pro quo, if you will. The U.S. doesn't have the rights to tax Social Security
US
income,
Social Security, yeah.
U.S. Social Security income for U.S. citizens or U.S. People who paid into the program in Canada. So it's a reciprocal, or it's an agreement to make things simpler, if you will.
Exactly. Yeah.
So, one of the strategies for entrepreneurs and for business owners is to be mindful of when they become a U.S. resident, that they now have, if they have a controlling interest in a Canadian corporation, they have something called a controlled foreign corporation. And they're subject to a number of different reporting requirements, but more importantly, some anti-deferral rules, where if certain types of income are in that corporation, it's as if it's attributed to you personally. Even if you can escape some of those personal attribution rules, there's some fairly new rules that come in, something called the Global Intangible Low Tax Income, or the unfortunate abbreviation of the GILTI rules.
Guilty tax.
Wonderful abbreviation. That basically says that if you have income over a certain level that's not connected to tangible assets, that's a portion of that is taxable personally. You get a mix, you get a mismatch. You get income that's subject to corporate tax in Canada, and then you get income that's subject to personal tax in the U.S. And it's hard to marry the two together. You may end up paying tax twice in the same income. And so we want to be mindful of that. And there's some strategies to avoid that, or to at least manage that. But one of the more common ways to handle this is something called a Canadian Unlimited Liability Company. And I can understand if you'd heard that term and said, well, why would I ever want a corporation that's got unlimited liability? I would agree with you. From a legal strategy, it's not that attractive. And that's why we see this more with investment companies, someone that's got a Canadian corporation that's got a lot of passive assets, a lot of investments, that doesn't have an operating business.
Yeah, I mean, it could be someone who created they're retired now and they just got investments and now they're just managing it, right?
Yeah. Or it could be a professional, a doctor, dentist, accountant, a lawyer that can't get liability protection anyways by having a Canadian corporation, so it doesn't matter what the status is. An unlimited liability company is just that. It's got unlimited liability. It's formed in a couple different provinces, but from a U.S. tax perspective, it's considered a disregarded entity if you own it, or a flow through. And the importance there is that the income, the expenses, if you've got losses, and more importantly, if you've got Canadian corporate taxes paid, it's considered a flow through, or it's considered like a partnership onto your personal U.S. tax return. So that unlimited liability company, or ULC, it'll be taxed the same way in Canada as a regular Canadian corporation. It's just that when it goes to the U.S., you can, as an individual, you can pick up the Canadian corporate tax as a foreign tax credit for U.S. federal tax purposes. It allows you to effectively time your income inclusions, time the characteristic of if you've got capital gains in the corporation, allow you to claim foreign tax credits. It allows you to get a much better result. And at the same time, it also reduces the amount of reporting that's done with your U.S. federal tax return. It's something that you want to probably do before you leave Canada, because when you're a U.S. resident and you either form a ULC, I guess that's possible, but if you convert your existing Canadian corporation to a ULC, that'd be a taxable event in the U.S. It's a non-taxable event in Canada. You can fairly straightforward process to convert a regular Canadian corporation into a ULC. Right. So you can do that, but you're generally wanting to do that before.
All right. Yeah.
We are at about 45 minutes right now, and we wanted to let you know that we'll answer some of your questions here. You will get a survey after this is done. We'd love to hear your feedback on this. We've done 3 of these now. We want to do more of these in the future, so if you can help us improve, that would be great. If you joined us last month for our Moving to Canada series with Warren and Krista, thank you for doing that. But if you haven't, we would encourage you to watch that as well. It's available on our YouTube channel. Yeah. And it'll cover a lot of topics that we just didn't have time to cover today. Things such as controlled foreign corporations. That's right. What else was on there?
There was the passive foreign investment corporations as well. Yeah. And a little bit more in depth about some of the departure tax as well from Canada. So there was different areas. When you're moving to Canada and the US, a lot of the subject matter intertwines with each other, if you will, right? So thank you for taking the time. We'll stick around as long as we can in order to answer some of your questions. In the survey, you'll have the opportunity, if we don't get to your question, to please put it in the survey with your email address so we can get back to you afterwards with an answer if we're not able to get to your question. And Darren is a senior manager with our Calgary office. Do we have any questions, Darren?
Yes, we do have quite a few questions here.
Okay.
So the first question that we have was asked live. And so when a Canadian person moves to the US and they're looking to step up the basis, how do they go about that in their US tax return, and how does that look?
So a Canadian person moving to the US and looking to step up their basis, was that the question?
Yeah. And how do you reflect it in your tax return?
Sure, yeah. So that is it's merely just an election in your U.S. return that you're claiming under the treaty in order to bump up the basis. It's a reporting requirement. So long as you're not a U.S. citizen or a U.S. green card holder, there's no dispositions that you're reporting in your U.S. return. So it's just a matter of an election that gets done
on your first return.
On your first timely filed return in order to create that basis. Now, it's a little different for U.S. citizens and green card holders, but same concept, exactly.
Yep.
Great. So our second question here. So throughout the presentation, there's a lot of emphasis on the implications in different states. Namely, it seemed California was extremely punitive and that they didn't follow the treaty. Are there actually states that are favorable to be resident in for tax purposes?
That's an interesting question. And I think the answer to what states you should move to, I think it's a bit of the eye of the beholder.
Yeah.
There are states in the U.S., there's probably a half a dozen to a dozen that have no personal income tax.
That's right.
Places like Washington State, places like Texas,
Florida,
Nevada.
Yeah.
So there's no state income tax on a personal level. There will be other levies you may pay, but those are very attractive places if that's your main focus. There'll be other states. I know, for example, Arizona will follow a lot of the elements of the Canada-U.S. Income Tax Treaty. Other states, such as New York, will cherry pick from time to time.
That's right.
It's a hard one to answer definitively. It really depends on which state you're going to. And I think I always talk to people and say, you've already decided where you're going first in general terms. So let's look at that.
That's right.
If you got some choices and tax is a real driver, let's look at those low tax, zero tax states. If you can land in Nevada and still do what you need to do in California, but have your life created in Nevada, that's going to save you a significant amount of money. The top marginal tax rate in California is over 13%.
13.6, I think.
Yeah,
now. Yeah.
Nevada is that much. So.
Yeah. Well, and generally states will find a way to get taxed. So Texas, for instance, yes, it has no personal tax, but there are property taxes and there are other types of taxes. They can get higher, right? So sometimes you have to be careful not to let the tail wag the dog a little too far and looking at life as well. So,
absolutely.
Yeah.
Good question.
Great. So you guys had talked quite a bit about married filing joint and the benefits around that, how there are higher income tax thresholds and standard deductions. Are there other benefits or potential detriments from filing jointly with your spouse?
Go ahead.
Detriments, there's a lot of laws in the Internal Revenue Code that protect individuals who marry, file joint, several liable. So you typically can't be held liable for something if your spouse does it and you don't know it's happening. You are somewhat protected. So even though you're filing a joint return, there is that little bit of
innocent spouse relief rules.
Yeah, innocent spouse relief rules. So there's situations in which you can be protected. Now the benefits, I would say most of the time, if you have the choice, you want to file married filing or jointly, not separately. If you have the option to file married filing jointly, because you double, as I said, you double the deduction, the standard deduction from $12,000 to $24,000. Your exemption amount goes up, so the limitation in which you have to file goes up. Qualified dividend rates double. So it's creating a lot of different brackets in which your rates go down.
It's a real advantage. It's one that we don't see in Canada, because in Canada we all file individual tax returns as even though we're a family unit.
And we're limited under TOSI. They limit us in
TOSI being the tax
on split income. Exactly. They limit us. They don't want us to equal out our tax rates between a married couple. But in the US, they're okay with that, right?
So when you see a married couple where one spouse has a lot of income, the other has very little income, filing jointly will make a lot of sense. You want to overlay that too with a half a dozen or about 8 states that have what are called community property rules.
Yes.
In Washington and California.
California is one as well. California comes up a lot.
It does. The idea is that you're kind of already in an equal environment. So the community property meaning that each spouse has an equal opportunity to earn income or to take. They basically take half the income and split everything.
Yeah. So
in theory, you're already there. So if you were concerned about liability or something else, you could file separately. So it's hard to give you a one answer, but those are some of the pros and cons for it.
That's right. Yeah.
Great. Thanks for that. So could you also please describe again the implications for a TFSA account when an individual moves to the US and what the implications would be if an individual was to contribute to the plan as a US resident?
Sure, great question. So a tax-free savings account, when you leave Canada, it maintains its status for Canadian tax purposes. For Canadian tax purposes, income gains, dividends are still tax-free from a Canadian perspective. From a U.S. perspective, that's not the case. The U.S.-Canada Income Tax Treaty doesn't recognize and doesn't address tax-free savings accounts. So as a result, you'll be subject to both U.S. federal and state income tax on interest and dividends and gains realized in the account. Mm-hmm. That still may not be a bad thing to have because U.S. tax rates are generally lower. You're just not getting the benefit for it.
And that's where the pool of foreign tax credits could come in handy.
It's possible. That's right. So the idea there is that if you are subject to U.S. federal and state tax on certain income from a tax-free savings account, if you had other foreign tax credits that you couldn't use, and if they're in kind of the same characteristic, you may actually get tax-free status in the U.S. for a certain length of time. Mm-hmm. Once you make contributions to that plan after you leave Canada, you're going to run into problems. There's penalty provisions that generally prevent you from making further contributions. And so we generally discourage people from making future contributions. There are other plans one should consider that are similar to a tax-free savings account. You'll hear something called a Roth individual retirement account or a Roth IRA. It operates somewhat similar to a tax-free savings account. You don't get a deduction or for your contributions in, but you can effectively earn tax-free income and then, in time, take the money out tax-free. So there's better options for you there. It used to be a big question on tax-free savings account. Well, what is that for U.S. tax purposes, and what do I have to tell the U.S. government about it? It's a foreign account, no question. And so if you've got more than $10,000 in any non-U.S. accounts, you have an obligation to disclose that information to the IRS. And it's a specific form number. It's a FinCEN 114. That's more of an information disclosure. Yeah. We don't consider that a trust under U.S. tax law. It doesn't meet the definition of a trust. So any of the trust reporting requirements we don't think are required. And I don't think we're alone in that opinion. So
yeah.
Perfect. There was one other question just regarding registered disability savings plans. It seemed a little complex to try to address in the minute that we have left. So I invited the individual to reach out to us directly.
Sure.
I think that's the last of the questions. Yep.
Perfect.
Well, excellent. I think that's a great place here. We're just on the hour. I wanted to thank everyone for their time today. We do enjoy putting these on and love to get feedback. Again, if you get time to complete the survey, let us know how we can do better. That's great. Krista?
Awesome. Thank you. Yeah. And I echo what you say. It's we enjoy sharing this knowledge. And, if there's anything, if you have questions, please feel free to reach out. We're here to help and hope everybody's doing well. Thank you.
We'll see you on the next one.